Welcome to episode 189, Michael Platt, Low Volatility King of Wall Street, 10 Trading Lessons. This is an outline of episode 189. Lesson number 1, Michael Platt is the Low Volatility King.
And they're willing to pay fees even if you're not actually engaging the market?
Oh, but we are engaging in the market. I mean, this year we made 10%. The history of Capital International is 15%, 20 gross IRR since it started. This year we've made 10% for the investors on a gross level. So,
but you still have traders today who have extremely good return to risk, which I think is the key element. You know, so you take somebody like BlueCrest, Michael Platt. You know, they're running now close to $30 billion. The flagship fund, you know, he's run this fund with mid-teen returns for, I don't know, close to a dozen years. And he's never lost, they've never had a drawdown which even reached 5%. To me, that's incredible. That's really phenomenal skill.
Lesson number 2, Jim Thorpe is the intellectual father of low volatility.
A brief journey from your card counting days to investing on Wall Street.
Well, I got interested in card counting because as a mathematician, I happened to go to Las Vegas and play blackjack for fun. And when I did it, I saw how to beat the game. So I sat down to work it out with computers. I went on to figure out how to invest in Wall Street. And I developed some methods for analyzing options. I formed a hedge fund. And what I learned in the casinos proved out to be very valuable in Wall Street. There's quite a similarity between casinos and Wall Street.
Ed Thorpe is one of the original traders. He goes all the way back into the 60s in terms of trading, and he has, of all the traders I've ever interviewed, and in fact of all the traders that have ever existed, Simmons with Renaissance, and I'm not sure who has the better record, but he would I think have one of the 2 best records that has ever been compiled in trading in terms of return to risk. 90, he has about, I think it was the exact amount, I think it was something like, he traded for the first fund for 227 months, 230 months, and he lost 3 months. It was like a ratio, it was like almost 99% of the time, the 3 losing months, he lost less than 1%. You know, and the return was near 20%. So that is just an incredible record. He became, in the hedge fund world where people don't know him enough, he was the first market neutral fund, the first one to come up with convertible arbitrage strategy. He actually developed what is the mathematical equivalent of the Black-Scholes model, which won a Nobel Prize, obviously, for its participants. He came up with that formula or mathematical equivalence of it about 5 years before the paper was published. But he was, in his own words, too busy making money using it to be worried about getting the fame for publishing it. And so he got no Nobel Prize, but he did enormously well. In fact, that first fund of his, which ran 19 years, had, we're talking a 19-year span with only 3 losing months in those 19 years.
Lesson number 3, the 3% rule to achieve low volatility. Here's a quote from Platt. I've never hit the 3% drawdown. Ego is how you lose money in this business. I put a trade on, and if it doesn't start working straight away, I respect the price action and cut it fast. One of BlueCrest's secrets is to make sure each of his traders does not go below 3% drawdown, or they're deprived 50% of the portfolio they manage. Another drawdown of 3%, the trader will lose his entire allocation. Lesson number 4, no losing years. Max drawdown was 4%.
I think the track record that, I mean, because we are traders and because we don't take any credit risk and we are super liquid, and that we've, you know, in the time that BlueCrest has been around, we've made $17 billion of trading profits for our investors. If you look at BlueCrest Capital International, in the course of making 350% for our investors, we've had a maximum drawdown of 4% over an 11-year history with no down years. And so in an environment like this, where we are a very, very secure trading strategy, taking no credit risk, not buying anything illiquid, not buying anything, you know, no buy and hold, I'll see whether I'm right in the end kind of trades. You know, that's the kind of thing that investors, frankly, really want to hear from someone like me.
Lesson number 5, stay highly liquid. That is no credit swap. Also, he can sell or liquidate within 1 day.
I would say that probably most of them are insolvent.
Most of the banks in Europe are insolvent right now.
If they were marked like I am at a hedge fund, yeah.
Well, then, has your relationship with banks changed dramatically? How do you feel about them as counterparties?
I don't take any exposure to banks at all if I can avoid it. All the money of BlueCrest Capital Management is in 2-year US government debt, 2-year German debt. We have segregated accounts with all of our counterparties, and yeah, we're absolutely, radically concerned about the credit quality of our counterparties.
Michael.
Lesson number 6. Highly liquid is how he survived and thrived in the 2008 financial crisis.
But you're not tempted, just as you're saying banks are shedding assets. We're hearing from many investors saying this stuff is too cheap to ignore. It might be liquid, but I've got the cash, I'll sit on it. You don't feel that way?
No. It would have been the end of my business in 2008 if I'd done such a thing. Anybody who had illiquid positions within their hedge funds, there were runs on those hedge funds because people wanted to get the cash out and not be side-pocketed with the illiquids. I mean, in 2008, I paid out $9.5 billion to the street because I was the only hedge fund that was up a lot and completely liquid.
Lesson number 7. Big money in trading is made in the aftermath of the crisis.
We take risk in financial instruments such as futures and options and swaps. However, I think the most important thing to remember about crises is that you don't make your money going into the crisis. Because when you go into a crisis such as 2008, markets trade against positions. Okay, and people have positions on, and people need to get risk off. Okay, so all the things that people thought were a good idea start going into reverse. The big money that you make in trading, right, is more in the aftermath of a crisis. In 2009, we made 60% with no down months on our master fund, our $10 billion Capital International Fund.
Now, is this
Lesson number 8. His trading model has not worked well in equity trading. For example, in 2004, he opened an office in Hong Kong, only to close it in 2017. Lesson number 9. An investment is a short-term trader gone wrong.
BlueCrest special sauce? It sounds like you're saying we're not investors, we're traders.
Oh, we are absolutely traders. To me, an investment is a short-term trade that's gone wrong.
Lesson number 10. Look for trends that are unsustainable.
A requirement for banks to increase their capital. Therefore, we're looking at a €3 trillion takedown in European balance sheets. And there's basically nowhere I can see we're going to get any growth from.
To you, then, this is all about economics. It's not about the cultural divide between these countries and politics. It's just economics?
Absolutely, it's about the cultural and political divide. The reality is that there is no willingness within the Eurozone to share wealth. In the United States, money flows between different areas. If California is having a very difficult time, the rest of the United States will send money to California. This is not the case in Europe. There is no willingness to transfer money across boundaries in a long-term and sustainable way.
Thank you for watching. Please subscribe and leave your questions and comments below. Wishing everyone peace and prosperity.